There's a strategy where you don't predict the market and still win. It's called dollar cost averaging, and it works by removing emotion completely.
All right, let's dive into something pretty cool today. We're going to deconstruct one investor's super detailed blueprint for building a serious portfolio. And this isn't just about picking hot stocks. It's a whole system, designed with one powerful goal in mind: getting to retire early. Let's see how it all works.
So let's start with the big number that probably got your attention: $418,000. That's the current value of the portfolio we're breaking down. It's a really solid number, and it was built using a very specific and honestly relentless method that we're about to unpack.
And this right here, this quote really gets to the heart of it. For this investor, this portfolio isn't just some side hobby. No way. It's the engine that's literally going to decide what the rest of their life looks like. I mean, it's the difference between grinding it out for another 30 years and actually achieving financial freedom at 55.
So, what's the thinking behind a portfolio like this? What's the big idea? Well, it all starts with a really clear philosophy, a core mission that guides every single move they make.
Okay, so the main goal here is pretty simple, but it's also really ambitious. Don't just ride the market, strategically beat the S&P 500. And you might ask, why? Well, if you want to hit a big goal, like early retirement, you need that growth to accelerate. Even beating the market by just a few percentage points every year can literally shave years off your working life.
And check this out. This chart shows it's actually working, at least in the short term. The portfolio is constantly being measured against its main benchmark, which is the VOO, an ETF that just tracks the S&P 500. And you can see right here, in the last month, the portfolio pulled in 11.4%, while the benchmark did 9.7%. It's these little victories, week after week, month after month, that are designed to snowball into a huge advantage over the long haul. So, how do they pull this off? Is it some crazy market timing or risky day trading? Nope, not at all. It's actually powered by a super disciplined, totally automatic engine that just hums along in the background, week in and week out.
The secret sauce here is actually a classic strategy, something called dollar cost averaging, or DCA. All it means is you invest the same amount of money on a regular schedule. That's it. It completely takes emotion out of the picture. You just set it and forget it. And what happens is you end up naturally buying more shares when prices are down and fewer when they're up. It's simple, but it is so powerful. And here's exactly how this person puts that idea to work. The system is just incredibly simple. $1,000 invested every single Monday morning, automatically. It doesn't matter if the market is flying high or taking a nosedive. The key is that third step: ignore the noise. That consistency is the absolute bedrock of building real, long-term wealth.
And when you do the math on that, wow, that $1,000 a week really adds up fast. We're talking $52,000 of new money being invested every single year. And get this, that's before a single penny of market gains or dividends even comes into the picture. That is a powerful foundation to build on.
Okay, so we've got the why and the how. We know the philosophy and we know about the automatic engine, but what's actually in this thing? Let's pop the hood and take a look at the different parts. So here's the bird's eye view. The whole portfolio is built with just 7 ETFs. You can see the biggest chunk, that 30%, is VOO. That's the S&P 500 anchor. But then, built around that core, you have big slices for things like SPMO, which is a momentum fund, QQM for that tech-heavy growth, and SCHD, which is all about future dividend income. And that last slice, that's pure aggressive growth in some really specific sectors. And none of this is just thrown together randomly. You can actually think of it like a building with 3 distinct pillars. First, you have the foundation. That's 50% of the portfolio. It's your core market exposure. Then you've got the growth engine, another 35%, designed to really push performance past the market average. And finally, that last 15% is all about future income, which is where that dividend ETF, SCHD, comes in.
Okay, now this next part is, I think, pretty brilliant. It's all about what happens with the dividends. So instead of just having them automatically reinvested back into the fund that paid them, they all get pulled together as cash. Then, that cash gets invested with the regular weekly $1,000 into whatever part of the portfolio is lagging behind its target. So you could have dividends from a steady, value-focused fund ending up buying shares in a high-growth tech fund. You're basically using value to systematically buy growth. It's so smart.
So you can see how all these pieces are built for one thing: playing the long game. Every single decision we've talked about is laser-focused on that goal of retiring at 55. Let's look at how this whole strategy is designed to play out over time.
This brings up a classic question a lot of people have, right? If you've got extra money coming in, is it better to hammer down your mortgage and pay it off early, or should you invest that money instead? Well, for this investor, the answer really just comes down to the math. And I mean, this chart basically screams the answer. The mortgage rate is super low, just 2.25%, but the portfolio's return over the last year, almost 30%. When you see it like that, the choice is kind of obvious, isn't it? The money can make a way bigger return in the market than the interest it would save by paying down cheap debt. It's all about making your money work as hard as possible for you. Now, this is really important. This portfolio isn't meant to stay this way forever. It's designed to evolve. As you can see on this timeline, right now, at age 45, the focus is 100% on growth. But as that retirement goal of 55 gets closer, the plan is to slowly start shifting things, bulking up the allocation to that income-generating fund, SCHD. The whole idea is to slowly turn this thing from a growth machine into an income machine. And this explains the strategic reason for using this specific type of account. You know how with most retirement accounts, like a 401k, you get hit with penalties if you withdraw before you're 59 and a half? Well, this taxable brokerage account is the workaround. It's being built to spin off enough income to be a bridge to cover all the living expenses for those critical years between retiring at 55 and when those other retirement funds unlock without penalty.
So at the end of the day, what we've just walked through is one person's highly personalized blueprint. It's custom built for their goals, their timeline, their life. But it's an incredible example of how having a clear mission, a consistent system, and a smart strategy can really pave the road to financial freedom. And it kind of leaves you with a big question to think about. What does your own blueprint need to look like to get you to where you want to go?
But the real power isn't timing, it's what happens when consistency compounds. Subscribe if you want simple strategies that actually work long-term.